Thank you for joining us for a gift planning boot camp. If you're listening to the recording or here with me live, Libby and Kara, thanks for being here with me live. So I'm not by myself. If you have questions about gift planning at any time, certainly call our foundation office or email me at cspaugh@mmfa.info. I'm happy to help. We are doing this summer series. This is the first of 4 calls that will look more deeply at planning vehicles for gifts to churches and ministries. So today's topic is split interest trust, or split interest gifts rather. So the agenda, we're going to look at what are split interest gifts. Specifically, we'll talk about gift annuities, which is a type of split interest gift. We'll also do a deeper look at charitable trust, specifically charitable remainder trust. We'll reference the other split interest gifts, but we're not going to go into them in depth, and I'll explain that, the whys to that as we cover that. Then toward the end of our call today, there's a geek portion. I say nerds only because if you're listening to the webinar, you might want to cut it off at that point. We're actually going to go into a look at the tax return of a charitable trust because that's really where the magic happens and where you have to see some of this actually play out in reality. And a part of that will be a coverage of taxes and the tiered tax system of a charitable trust. And we'll also talk about traps and reminders. So if everyone's well caffeinated, we're going to start through this. So split interest gifts, what are they? Characteristics of a split interest gift. The first thing in the charitable realm's a little weird because it's a split interest gift is not exempt from tax. So what that means is somebody's got to pay tax on some portion of that gift. And usually it's the payment portion of the gift that comes back to the individual. So a lot of people think, oh, I can set up this trust, I can get payments from it, there's no tax. That's not how it works. Somebody has to pay tax. The revenue man does come calling. There's some unexpired interest to somebody other than a charity. That's the second bullet point there. So split interest gift allows an individual or individuals, plural, to be paid something, some stream of income. All of these have to be created past May 26, 1969. There was a big piece of legislation in 1969, and most charitable tax law links back to the 1969 Tax Act. And that's really what defined a lot of these split interest gifts for charity. Split interest gifts are usually one of the following types. Again, we're going to go in depth on what a charitable gift annuity is. That's the first type. We'll also go in depth on charitable remainder trust. I will mention charitable lead trust. I will not talk much about pooled income funds because I don't like them. The reality is pooled income funds are really a dinosaur. Most charities that ran pooled income funds have reformed those to be some other type of endowed vehicle versus the pooled income funds. And if you think of where income rates are currently, they've been low for 25 years now, at least. And that's why pooled income funds fell out of favor because they just paid an income return. And when people created these, income rates were a lot higher. Income rates below 2%, suddenly you're not getting a lot of income. And people start to question why they made the gift. So pooled income funds just don't really exist like they used to in the charitable planning arena. And we don't run one of those at Moravian Ministries Foundation, so we're not going to go into that. So we are going to talk about charitable gift annuities. The way to live forever, we joke here at the foundation, is to be Moravian and have a charitable gift annuity. It is partly a joke, but partly true. Our folks, our clients and donors that have charitable gift annuities live a long time. There's a lot of them in their 90s. There's some north of 100. It's really a way to live the blessing that God's given you and that you've given back through the gift annuity gift. So charitable gift annuities are contracts. These are not commercial annuities. They're not tied to insurance vehicles. They are contracts in which A donor or taxpayer transfers some sort of asset to a charity in return for a payment stream. And because it's a contract, that payment stream is guaranteed for their lifetime or the lifetime of somebody they love. You can't do charitable gift annuities for a term of years. It's always over a lifetime. And there's a lot of things that go into the calculations. We'll see some high-level examples of that later. But life expectancy is certainly a huge part of that. Current interest rates are part of that. And then there's gift annuity rates that the American Council on Gift Annuities actually publishes. So gifts may be for the life of one annuitant, or one annuitant followed by a successor, or it could be the benefit of two annuitants, like a husband and wife, et cetera, for as an example. The succession is after one enters the more immediate presence of the Lord, it would just pay the other person for their lifetime. Kind of a max of 2 lives on most of these. Annuity payments may begin immediately upon the donation, or they can be deferred. Obviously, if you defer payments, you're eligible for a much higher payment and a larger tax deduction. So sometimes it makes a lot of sense to defer the payment if you don't need the income right away. At our foundation, we require for charitable gift annuities a minimum gift of $10,000, and you've got to be at least 70 years old to start benefiting from a gift annuity. You don't have to be that old when you create one, but you have to be that old. Not that 70 is old. It's just you're young, 70 years young. But to start benefiting, the person has to be that old. So we run into challenges with that when people want to create these gifts for their kids. They can't start getting paid until their children reach age 70, for example. And the reason you would do that is, if you sit back and think about it, almost common sense. Again, our foundation's creating a contract to agree to pay a specific amount for a lifetime. So the younger the person is, the longer we have to agree to pay that specific amount, and the more risk as a charity we would encounter that that person would actually outlive their gift. Potentially, the gift could go down in value, and we could pay out a lot more as a liability for our foundation versus the value of that gift. This type of gift is always a two-pronged transaction. So you have prong number 1 is a charitable gift. Prong number 2 is the investment in an annuity contract. So once the gift is made, the person takes a charitable income tax deduction. They're eligible for that depending on their individual tax situation. And then the gift, whether that be stock, assets, cash, it's liquidated to an investable form, and we invest those assets. So if everything works like it should, the market goes up, investments grow, what ends up happening is the charity at the end of the day will get far more than the original gift amount. And if the person lives a long time, they're going to get more back in payments than they originally donated as well. So again, it's two-pronged transaction. The gift, you make a charitable contribution, get a charitable income tax deduction. The second one is you invest in an annuity contract. But again, not a commercial annuity. Those are totally different and linked to insurance. All right, there are different types of charitable gift annuities. Just to hit on these, the immediate charitable gift annuity is what we see used the most. That's where somebody makes that charitable gift. They immediately get that contract and it immediately begins making payments. That's usually how it works. There's the deferred gift annuity, which is exactly what's in the name. You kind of defer the payments out to a future date and time. Maybe you want to defer it out till you retire, reach a certain age. That's certainly a possibility. You could just simply defer it out by a couple years. And sometimes it pays to look at those different options because again, increases your payment amount and could potentially increase your tax deduction to defer payments on a charitable gift annuity. The flexible deferred gift annuity is one we don't see a lot, but is a pretty slick vehicle. Payments are deferred to such a time as chosen by the donor or annuitant. Calculations certainly have to be based on the expected dates. So if you say, hey, I'm going to donate this for a charitable gift annuity and I want to start getting payments when I retire, I plan on retiring at age 70, but something happens and you retire at age 67. What would happen in a flexible gift annuity is your payment would be less than that original calculation amount. The tax deduction is based on what you originally put in. It's going to be based on age 70. So the way that adjusts is by actually reducing your payment. The reverse is true. If you say that same example, I'm going to make this gift, I'm going to start taking payments when I retire, but I don't retire to 75. Then the payment to you would actually be more than the original calculation because you delayed payment in that case. So flexible gift annuities are a slick way to do some planning and really give you flexibility as a donor. This has a couple of examples of charitable gift annuities. I think it helps to see these play out in real life. So this one is Jane's sample, and this is an immediate charitable gift annuity. Jane creates an annuity, payments begin immediately. The little flow chart at the top shows how this works. She's going to give $10,000 of appreciated property. She could very easily have done $10,000 cash. Appreciated property works a little bit differently because you have capital gain in that. Our illustration shows that she had a cost basis of $2,500. So there's $7,500 in gain there that she doesn't have to realize because she's donating it to this gift annuity. She gets a 6% annuity contract back for her gift. You can see the math there on what her charitable income tax deduction is, as well as her annual payment of $600. This projection shows that if all works exactly as planned, and Jane enters the more immediate presence of the Lord when she's forecast to, and the market does what it's supposed to, then her church or favorite Moravian ministry at the end of her life will receive $14,299. This example builds in an 8% return for the stock market. It also illustrates a factor that's true with charitable gift annuities. Your payment back is taxable to you as an annuitant. So that $600 in annual payment, she's going to have some tax liability on that. Some ordinary income, some capital gains because of what she donated originally, but a portion of her gifts, that payment's going to be tax-free to her over her life expectancy. What happens if she lives past 13 years? She's currently 78. This illustration projects, okay, she's going to live to be 91. If she lives to be 92, then her payment, that $600, will be totally taxed as income to her. So again, a portion of it's taxed as income, a portion is capital gains, which is typically more favorable than income tax, and a portion's tax-free up until the end of her life expectancy. At the end of that 13 years, then it's all taxed as income. Again, the tax people get their revenue somewhere along the way. But again, the beauty of this is certainly if the market does better than 8%, returns more, then there's going to be more money left at the end of the contract for her favorite charity or ministry. This is another example of deferred charitable gift annuity. And this one is with John Huss, and John creates charitable gift annuities for his children when each child turns 70 years old. This really shows you the beauty of investing in compound interest. John donates $50,000 of appreciated property. He has a $10,000 cost basis. And because of the deferment, his children's current ages today are 47 and 49. So this gift's going to have a lot of time to grow before they start benefiting from it. Therefore, it gets them a larger annuity payment and the amount going to charity potentially at the end of John's children's lifetimes is projected to be $1.5 million over that. It's a pretty amazing gift. If you wanted to leave funds that were somewhat controlled to your adult children, this would be a great way to do that and benefit charity in a huge way in the future. And again, the charity is projected to have over $1.5 million. Now they have to wait a little while for that money because John's children are projected to live long, healthy lives. But again, huge benefit in the end. That's charitable gift annuities. I've got one slide really in here on charitable lead trust. Charitable lead trust haven't fallen out of favor quite as hard as pooled income funds, but charitable lead trust are largely used to save estate taxes. And in 2021, the estate tax exemption's up to $11.7 million. So for married couples, it's double that. And in the Moravian context especially, we just don't see that many folks with an estate that's north of $23 million in size. And usually there's other assets. They're not trying to get assets out of their estate to save on taxes. It's just the reality of where we are. Lead trust can still be great tools for those that do have ultra high net worth estates and are doing planning purposes. There are two types of lead trust. Charitable annuity lead trust and charitable lead unitrust. These work the opposite of a remainder trust that we'll get to. So charitable lead trust, obviously there's a trust instrument. A charity, in our case, churches or agencies benefit from that trust over a term of years or over someone's lifetime. And then at the end of the term, the assets go back to individuals. In a grantor lead, obviously the assets would go back to the grantor, and a non-grantor lead, they typically go to children or grandchildren. So again, charitable lead trusts, when they're created, have to pass a 10% test. That means they, based on projections, they have to have at least 10% of those assets left at the end of the trust term. Charitable lead annuity trust are typically better if you're leaving assets to grandchildren, just because they only get looked at one point in time for generation skipping taxes. If you do a unitrust, that's looked at not only at funding, but it's looked at the end of the trust as well. So annuity trusts are better for the grandchildren. Non-grantor lead trust are actually taxable trusts. So everything that happens inside the trust, those do have to file a 1041, similar to an individual's 1040. And those are taxable trusts. In a grantor lead trust, the grantor pays all the taxes. So that gets taxed to them on their individual tax return. These are great for, again, ultra high net worth families that are philanthropic, that want to, make grants, do things throughout the year. They can use these assets. And if played rightly from a planning standpoint, it gets the value of those assets out of their estate for calculation purposes. And it is a nice way, if the assets appreciate, to pass assets to future generations. So it's a great planning tool. But again, with the estate tax exemptions so high like they are today, we just don't see these lead trusts used quite as much. Charitable remainder trust, however, we do see used a lot. And there's a lot of great planning tools for charitable remainder trust. So we're going to spend a lot of time talking about charitable remainder trust. This is the opposite. A donor creates a trust. They themselves, their spouse, children, somebody benefits from it in an individual capacity, similar to a gift annuity during their lifetime or over a term of years. You can do trust for a term of years. And then at the end of the term, whether that be when someone enters the more immediate presence of the Lord or the 20th year passes, whatever, those assets that are left in the trust pass to charity. So in our case, they would pass to the church. There are two basic types of charitable remainder trust, an annuity and unitrust. The unitrust has a lot of children, a lot of subtypes, and we'll get into some of what those differences are. So this slide talks about a charitable remainder annuity trust. Again, these aren't used a lot anymore, but this is one of the types. Primarily to qualify for a charitable remainder annuity trust, it would have to be an older individual, typically in their mid to late 70s for a trust to qualify. These trusts do have to pass a 10% test. And again, with an annuity, it's funding happens at one time. The calculation of payments happens when the funding happens, and then the payment is locked in for the life of the trust. So unless you have great investment returns, the person could actually outlive the benefit of their gift in trust. So again, these have fallen out of favor a little bit because of what happened in the mid 2000s to 2010, where market returns weren't quite as good those years. A lot of people just saw these trusts exhaust because of the guaranteed payment to the individuals. Again, that 10% test, there has to be 10% forecast to be left at the end of the trust term. It's harder to get that to work with an annuity trust. That's why it has to be usually an older individual that's doing that. The benefits of a charitable remainder annuity trust, again, it's a fixed stream of income. Somebody looking for that guaranteed income every month, quarter, year, whatever the payment cycle is. It's a great tool for that. It helps people diversify their portfolios a little bit to get assets into a trust. You get a charitable income tax deduction. Typically, these are six-figure gifts, so usually that helps from a tax standpoint as well. You get capital gains tax savings as well. If you're donating appreciated assets, the assets are sold within the trust. So it allows you as a donor to defer capital gains as those payments pass out to you. And again, we'll see that more in our geek section later. If you need an estate tax deduction, if you're one of those folks that have an estate above the $11.7 million, again, this would help with that. Of course, the charitable interest wanting to help your church or favorite agency, that is a huge benefit to doing this type of gift. And these can also be used for income replacement. So you can actually use the payment stream from a charitable remainder trust to buy life insurance that then could benefit your heirs or beneficiary of choice down the road as well. Potential clients or potential people that may be interested in this, and those of you listening to the recording, think about folks in your church or fans and volunteers of your agency that might fit this category. It would be somebody that needs steady income for some reason. Somebody maybe that has a concentration of a low yielding asset, either stock or property, real estate of some kind that just isn't producing anything for them. They want to turn it into income producing property. This is a way to do that. Somebody that needs an income tax savings or an estate tax savings obviously would qualify. Also, you want to look at people that have few or no heirs. So no one to leave their assets to, that may be looking to plan, when they enter the more immediate presence, how they really benefit their church or ministry. Those would be the folks you'd think of for charitable remainder annuity trust. Charitable remainder unitrust are used a lot more. This is the regular type unitrust. The value recalculates every year, so you don't run the danger of these exhausting whatever the value is on 12/31 of the year. Then your payout is based on that value. So similar to charitable remainder annuity trust, the payment has to be set between 5 and 50%. Obviously, the lower you stay with your payout, the larger your charitable deduction is going to be. Most of these are around 5 to 7% in terms of what donors choose or beneficiaries choose for their payout percentage. And it's 5 to 7% of the value of that trust would be what the payment would be every single year with a straight CRUT. So the first one is standard CRUT, which is a straight unitrust. and that's the straight percentage payout. So again, the 5 to 50%, whatever that percentage is, times the ending year market value, that's what the payment is every year. The second type is the net income. Again, these aren't in favor like they were at one time, and net income with makeup means in years where you have more income than the payout percentage, you could actually pay out excess money in addition to the income payment. So again, net income with makeup, those are used very rarely anymore. Most people aren't happy with those, especially given current income rates. So we by far see standard or straight charitable remainder unit trust most of the time. The third one on the page, similar to a deferred gift annuity, this gives you a lot of flexibility. It's called the flip. That's because it would be a trust that starts as a net income trust or a net income with that makeup, but at some triggering event, it turns into a straight charitable unit trust. The best example of when to use a flip involves some asset-specific donations. If somebody's donating real estate, a house or land, there aren't any assets to make a payment to that individual. So if it comes into the trust, the trustee would face a challenge paying them their straight rate until that asset's sold. So you can set it up to, hey, we're going to set this up as a flip. It's going to pay net income until the real estate or property sells, and then it's going to flip to that straight charitable trust. Another great example of that is maybe planning for retirement. You want to fund a charitable trust as a retirement planning tool. You just have it set for net income because you don't want additional taxes while you're working, and you can fund it, contribute to it, and then whatever your retirement date is in the future, that could be when it flips to that straight payout. So again, all of these are probably classes in and of themselves. They get very complex. This is just meant to be a high level overview. And again, if you have questions, email, call, we can go in depth with this. Triggering events, by the way, for the flip, they've got to be things outside of the donor's control. So weird things as triggering events that I've actually seen is somebody getting married, somebody getting divorced can actually be a triggering event. The birth of a child can be a triggering event. Attainment of a certain age. Again, I use the retirement date. That's kind of the thing you would do there, attainment of a certain age, then it would flip to that straight. Again, it's got to be out of the control really of the donor and the trustee. They can't just, on a whim decide what that's going to be and turn it on like a spigot. Doesn't work that way. All right, here's an example of a charitable trust. Nick and Anna Zinzendorf create a trust, and this example, they actually created it with real estate. So $210,000 is the value of their property. It had a $70,000 cost basis, and they did a 5% charitable trust. You have to look at the fine print to get some of the details of the illustration. If you look at the fine print, it tells us that they're 75 and 72. You can run these illustrations on with any number of different examples and variables. Their income tax deduction is, again, based on that $210,000. It's got to be at least 10% of that has to be projected to be left at the end of the term. With this one, we're fine. There's enough years, there's enough value, it's fine. But their income tax deductions based on the present value of that remainder interest. So it's $97,310. Thankfully, we have software that does this math for us. What you see there is that all of that gain is not taxed to them right out of the gate. Again, because the gains realized inside the trust, and their first year payments would be $10,500. Now, after December, whatever the value of their trust is, that payment gets calculated again for the next year. You can see based on this projection, and they're based between both of them to live 22 years. if all of that works out based on the projection, the market behaves itself, have positive returns, you can see where their charity is projected to receive $402,382. Pretty amazing, because over 22 years, getting at least $10,500 a year in income back, that tells you they're going to get more income than they gave or than the property was worth originally, plus the size of the gift that's there for charity in the end. Is just an amazing benefit. So these are great, great planning tools for folks that have the assets and generosity to do a gift like this. All right, you guys have been good to hang with me so far. This is a slide that mentions future sessions about the gift planning boot camp. I think we started with the hardest one and certainly the most technical one. Future sessions next week, we're going to talk about donor advised funds. The week of July 27th, we're talking about endowments. And then August 3rd, retirement planning for charity. So you're going to hear some things in that mentioned again from today's session, because a lot of these tools are good retirement planning tools as well. So those are our future sessions. And that's your chance, if you've been listening to the recording, to exit, run for the hills while you can. This is, we're entering the section where if you thought you needed caffeine, you really do need caffeine now. And we're going into the geek portion of the presentation. We've got to look to really know how these work, to really see how they work. In terms of charitable unitrust, you've got to look at a tax return to really see how that plays out. Charitable remainder trust have to file what's called a 5227 tax return. It's an informational return because charitable remainder trusts are, in essence, tax exempt. The payments from them aren't tax exempt. The individuals have to pay the taxes on it, but the trusts themselves are tax exempt. So 5227 is really an informational return. But this shows you how it works. And I've got an example on the screen in front of us. So this is actually page 1 of the tax return. Page 1 is really an income cash flow statement. It shows what happened in the trust over the course of the year. It's going to show your interest income, which is, interest from bonds, notes, mortgages, treasury bills, etc. It's going to show dividends, and you see even separate lines for qualified versus non-qualified dividends. And qualified dividends are those, from U.S.-based companies received during the tax year. It's got to be a domestic corporation to be a qualified dividend. And usually your 1099s distinguish what's qualified and not qualified. But you could see the total income. And in this example, total ordinary income for this year was $32,674. But you see the next section that this trust actually had a lot of capital gain. Maybe they exited an investment and bought into a new one, or for whatever reason, this particular year they had $154,288 of capital gain. That's what happened within the trust. So again, keep that in mind as we look at these additional pages. If you go to the next page, page 2 actually starts showing the tier system. So charitable remainder trust, again, aren't taxable unless you do some really egregious stuff, but the payments from them are taxable. So those taxes to individuals go through tiers. You'll also hear the word buckets. We like the word bucket in the South especially, but they go through the different tiers. So it's kind of worst in, first out in terms of how stuff is taxed. So you look at ordinary income first, short-term capital gains next, that gets taxed at income rates. Then you look at long-term capital gains, tax-free income, and return of corpus. So that's return of principal. So when you get to the 4th and 5th tier or bucket, that's tax-free. So you can do a lot of neat planning with these trusts to really minimize the tax impact with the individuals. But sometimes based on the assets that are used to fund these, you can't really ever get past that capital gain bucket. Because if you think there was real estate or some appreciated stock used to fund this, there's going to be a lot of capital gains that just always accumulate and stay in the trust and never really fully pass out. So we look at page 2. To see it, you gotta, again, go through the tax return. And this shows you the carryover, the top line. If you look at line 27, that's carryover from the prior year. So again, these work like check registers for the trust. Ordinary income, there wasn't any carryover ordinary income. That makes a lot of sense. Interest rates are near zero, and so there's no income. There was actually a carryover loss that came over. Negative 113,979. That loss carried forward from the prior year. But row 28 shows you the activity from your current year. So the tax return we're looking at, this is the activity from that year. The trust had 17,534 in income, 154,288 in capital gain. So 29, row 29 shows you the summation of that column, and the income obviously stayed the same, but our capital gain totally wiped out the loss that was there. So if you're an income beneficiary of this trust, suddenly you're having to pay income tax on your payment at capital gains tax rates. And you didn't have to do that in prior years. So you might not be too happy with the trustee for creating that gain. What we usually see in trusts like this is that top number, row 27, is going to be a large number that never fully passes out because of the assets used to fund it. It's going to be a large positive number. Again, the trust realizes all the gains when assets are sold at funding, and that just never passes out. You see that in a lot of these trusts. But you have to be careful when that's not the case. And when you're in the trustee seat, like MMFA is and others, you can't create a problem where one didn't exist. You got to be real careful to try not to do that. So, but remember, 17,534 in income. We now have $40,309 of capital gains. So you go to page 3 of this return. This just shows you what the ending value of the trust was. That's really what I included this to show you the size of this trust. So total assets in the trust, 642,000. And then the following year was 772,000. So this is a balance sheet that really shows you a couple years of activity on page 3 of the tax return. We go to page 4 of the tax return. You see, again, continuation of the taxes in tiers, what we're talking about here, continued. But you also see a lot of questions. Charitable remainder trust are subject to the private foundation rules. So when a tax preparer goes through these returns, they have to answer a lot of questions. And basically it's questions on, did we do what we were supposed to do? Did we follow the trust document? Or did we violate any of the sins of a private foundation? Did we have self-dealing? Did we invest in something that was a jeopardizing investment? Did we have excess business holdings? All of those are questions you're going through to answer. If you answer yes to any of those questions, then you have to do a lot of explaining to the IRS. And in some cases, if whatever you did created unrelated business income, you have suddenly subjected the trust to taxes. So you got to be really careful not to harm the trust in any way. And we'll get into more of the traps of charitable trust on the last 2 slides. But unrelated business income is a bad thing because that's 100% tax to a charitable remainder trust. So you would wipe out all of that income immediately. The other thing about page 4 is this actually shows you the unitrust percentage for the trust. You'll see that this is a 6% charitable remainder trust. It also shows you what the payment amount was supposed to be for the prior year. So you'll see 51,253 That's what was supposed to be distributed in the tax year. And again, you've got to take the 51,253 and now it runs through the buckets or the tiers. And again, a reminder what those tiers are in terms of how that payment, that 51,253 is what the beneficiaries would have been paid on this trust. So how is that taxed? It's taxed first on ordinary income, short-term, long-term gains, then non-taxable income and corpus. My little acronym for that's on Sundays. Larry's not cool. You can come up with your own on how to remember the order of those tiers, but it's worst in, first out, whatever helps you remember that. Page 7 is where you, of the tax return, is where you actually see this play out. So if you remember, our payment was 51,253. So of that, we had this amount of income and we had more capital gains than what was left. So we're still going to have $6,590 of capital gains left. So that carries over to next year. So that'll be on page 2 at the top of the column next year. But this also should tell you, and we don't have an example K1 in here to look at that, but this is how that would go to the K1. The beneficiary would have to pay income tax on $17,534 and capital gains tax on $33,719. That's how that works. So this beneficiary is going to be mad because they're not used to seeing that $33,000 number. They're used to having ordinary income, and then suddenly it goes to a non-taxable bucket, either tax-free income or that return of principal. And this time they're going to have capital gains taxes to pay. So again, really to see how all this works, you have to see it on the tax return itself. Things to remember with charitable trust and lead trust that are very important and can turn into types of traps. Charitable trust, any type, can't have debt finance real estate, I can't say that, without creating some problems. So property donated with a mortgage, that would create issues. You can't own partnerships, oil and gas interests. The reason you can't have those is they create unrelated business income. And remember, with a charitable trust, unrelated business income is 100% tax with charitable trust. You can't own subchapter S stock. That's simply, you have to look at the subchapter S rules to understand that, but charitable trusts aren't listed as a recipient of subchapter S stock. So you can't own that. So that's, subchapter S is small companies, typically less than 100 shareholders, and they get to exist tax exempt, and they pass all their earnings out to the shareholders like a normal corporation would do. But you can't, charitable trust can't own that sub S stock. It would cause the stock to lose its S election, basically. So it causes a lot of problems other than just problems for the trust. If the property is real estate, be sure the donor recognizes their entire interest has to be placed in the trust. So if they donate real estate and it's a home, they can't continue to live there. Guess what? Their son can't continue to live there either. So if somebody's been hiding in the basement, that's a relative, you got to kick them out when you donate it to the trust. You can't enjoy to any of that personal benefit of that property because that violates the private foundation rules of self-dealing. You're getting self-interest or self-benefit back from that property. Can't tell you the number of examples that somebody donated a house and found out somebody was living there and it was somebody's son, and it just creates all kinds of issues. So you can't do that. Debt finance property, if it has a mortgage on it, that's not a killer in and of itself, but it does create a lot of problems. It can underscore the charitable deduction and create some other challenges for it. Privately owned businesses, those closely held businesses similar to the subchapter S, should raise red flags, because if it's a family owned business, typically the family's involved, they're going to want to continue to run it. There's conflicts of interest, and you could run afoul of the private foundation rules, either self-dealing or otherwise. So continued here, if the remainder beneficiaries are skip people, if you're not familiar with generation skipping, it's a way that people try to pass assets to their grandchildren or future generations, great-grandchildren, by skipping their kids or the successive generation. So just be aware, if it is a skip person that's the beneficiary of the trust, that creates generation skipping tax issues. It helps to know that, and that goes with the knowing your remaindermen, know who the beneficiaries are. Make sure you pay close attention to that if you're in the trustee seat. Be very clear on who all these people are, donors, planners, etc. Make sure all this is clearly defined. We didn't talk a lot about lead trust, but remember, non-grantor leads are taxable trust. People forget that. They think they don't have to pay tax on it. That happens particularly at the state level. They'll remember to pay federal tax, but they forget, oh, I didn't file a state tax return. You got to file a state tax return as well. Totally tax. The states want their money as well. And again, there's some other stuff there on lead trust. Funding issues, termination issues, make sure they're assets that can be liquidated and used to make the payments of the trust. Otherwise, that creates other challenges. And with that, I think I've reached the end of my prepared comments. I'd ask our two live participants if you have questions, if you're still awake. I'm seeing no. So either you're not still awake or you don't have questions. All right. That's good. Well, thank you, Libby and Kara, for hanging with me all the way through this. And if you're listening to the recording, thanks for tuning in. And again, if you have more questions, reach out to us. All right, ladies, thanks.
Thanks.